$600 million. Zero broker license on record. Zero confirmed clients. How did Jeffrey Epstein build a financial empire that no auditor can explain? And why did the world's biggest banks open their vaults for him? The story isn't what he did, it's how the system let him do it. Wall Street runs on one rule: follow the money. When investigators tried to follow Epstein's, they found nothing. He walked into Bear Stearns in the late 70s. He walked out managing the fortunes of billionaires, without meeting the most basic requirement in finance, existing on the books. J. Epstein & Co. and its successor firms were never registered as an investment advisor or broker-dealer with the SEC. Epstein wasn't a certified accountant. He wasn't a tax attorney. He operated in the shadow market. He charged fees that rivaled Goldman Sachs. He kept a Manhattan mansion, a private jet, an island in the Caribbean, but claimed to manage money only for billionaires, in absolute secrecy. Without ever naming a single client, on paper, he didn't exist. Epstein's wealth didn't come from financial genius. It came from fiduciary capture. Billionaire Leslie Wexner, founder of the L Brands empire, became the gateway. In the late 80s, Epstein convinced Wexner that his longtime advisors were incompetent. In 1991, Wexner signed an extraordinary sweeping power of attorney. Epstein gained total control over his entire fortune. Full power of attorney means signing checks in the client's name, moving assets between offshore trusts, selling real estate, buying and disposing of artwork. Every check and balance, gone. Wexner handed over the pen. Epstein started running everything as if it were his own. The extent of it became clear in the most documented transfer of the entire case, the Herbert N. Strauss House, one of the largest private residences in Manhattan, passed from Wexner to Epstein for a nominal price, $10. In modern compliance, that is a red flag the size of a building. When someone has unrestricted access to the vault and no one is watching from above, the line between the client's money and the manager's simply disappears. To survive 2 decades, a white-collar scheme needs a bank that looks the other way. U.S. law is clear. When a bank suspects the origin of funds, it has 30 to 60 days to file a SAR, a suspicious activity report, with the Treasury. J.P. Morgan Chase kept Epstein as a client for more than 15 years. In 2019, years after cutting ties with him, the bank filed 4,700 retroactive reports all at once. Over $1 billion in transactions that no one had flagged in time. Documents from the Senate Finance Committee revealed a pattern. Compliance teams raised flags, deposits with no clear source, cash withdrawals, millions of dollars between 2003 and 2005. Management buried everyone. Epstein was generating fees too large to disturb. When J.P. Morgan finally cut him off in 2013, Epstein moved to Deutsche Bank. In 2020, the state of New York fined Deutsche $150 million. The reason? It processed hundreds of suspicious transactions for a client the bank itself had already labeled high risk. Systematic cash withdrawals in round numbers, risk committee restrictions that never reached the account manager's desk. Together, both banks paid hundreds of millions in settlements to close cases for failing to monitor their own client. The compliance red flag wasn't broken, it was switched off. To hide what the SEC never saw, Epstein went to the Caribbean, the U.S. Virgin Islands, a territory that mirrors the U.S. tax code, but with loopholes of its own. The centerpiece was the Southern Trust Company. To qualify for local tax incentives, it declared it would provide consulting services in data mining and DNA databases. The Economic Development Commission approved it. The result? A 90% income tax exemption, 100% exemption on gross revenue. When investigators opened the books, they found a mirage. Southern Trust had not a single client in the data market. The handful of employees handled Epstein's personal logistics. And yet, tens of millions of dollars flowed through the company. It didn't stop at Southern Trust. Cypress Inc., Maple Inc., Laurel Inc., a network of shell companies built to hold real estate out of reach. Cypress bought the New Mexico ranch. Maple registered the Manhattan mansion. Laurel held the Florida property, the Virgin Islands. Attorney General's investigation uncovered the key detail. Each one of these companies reported virtually zero assets to the local government, just a few $1,000s in cash, while hiding hundreds of thousands in property taxes owed on the mainland. It was this structure, consulting companies with no clients, operating in a territory outside mainland standards, that let hundreds of millions move completely invisible. The global Know Your Customer system failed, not because of incompetence, because of calculation. Epstein moved more than $158 million in consulting fees without a single formal contract, more than the total compensation of the highest paid executives in the Fortune 500. The system processed it. The alerts were buried in the name of profit. The question that remains isn't where the money came from. It's how many other ghosts are still operating right now the exact same way.